The interest rate on Series I bonds will die April 10th. That is the day the Consumer Price Index comes out that will determine the IBond interest rate over the next 6 months, and it is going to be craptastic. You longtime citizens here in the Bowtie Nation are going to remember I highlighted IBonds in April 2022 when they were offering a 9.6% interest rate. I maxed out my $10,000 limit, bought 10 grand for my wife and kids. It was one of the best investments of the year. But those Series I savings bonds are about to be dead money. I'm about to show you what that new IBond interest rate will be and then detail 5 better places to stash your cash for that safe, high yields up to 15%, including the safest stock in the stock market. Let's walk through how Series I bonds work and how that interest rate is calculated so you can see how bad this could be over the next 6 months. The Series I savings bonds were started in 1998 to give investors a way to protect their money from inflation while still providing that guarantee of a U.S. government bond. So besides the treasury bills, notes, and bonds issued by the government, there are also these savings bonds, and they're all a loan to the government, but the interest rate on most of these are so low, it's about as worthless as a crocheted condom. Regular treasury bills, notes, and bonds are going to pay just 4.5% a year to lock up your money for 30 years. Even the shorter term bonds like the 1-year T-bill only pays 5% because Uncle Sam is a cheap ass. But then these Series I savings bonds, these were like the love child of Uncle Sam and Santa Claus for a while because the yield was unreal. You see, that IBond interest rate changes every 6 months and depends on 2 factors, a fixed rate and an inflation rate. Now that fixed rate never changes after you buy the bond. You can see here in this rate history, the fixed rate does change every 6 months, but when you buy a bond, you get that rate for as long as you hold it. So the investors that bought these IBonds from November last year through April of this year, they've locked in that 1.3% on their bonds for up to 30 years. So it's really the inflation rate that you have to worry about, and that is what is going to kill the bond coming April 10th. You see, the inflation rate changes depending on the Consumer Price Index for all urban consumers, the CPIU, over the 6 months before the rate reset in May and November. I'll show you how this is calculated next, but you can see as that CPI came down from that 9% annual rate in June 2022, the combined rate on the IBonds has come crashing down as well. You see how the combined IBond rate is calculated here on the Treasury.gov website, and it's actually a lot easier than it looks. You've got that fixed rate, which will change, but not by that much, so we'll use a 1.35 for our estimate. Then you just need the semi-annual inflation rate from the CPI, and we can do this calculation. That CPI over the 6 months through April 10th is the last piece of the puzzle, and economists expect annual inflation to be about 3% when it's reported. That would give us an index level on the CPIU of about 312. Then we take that number divided by the reading 6 months prior, the November level of 308, minus 1 for that semi-annual rate of about 1.298, or about 1.3%. So now we can follow this IBond composite rate formula. We have that 1.35% fixed rate plus 2 times the semi-annual rate of 1.3%. So that's this 1.35% plus 2.6%, or about 3.95%. Then plus the 2 factors multiplied by each other, which isn't ever really very much. Here it's just 0.0135 times 0.013, or 0.0001755. Adding these 2 parts together, then we get an IBond interest rate estimate of just 3.97 for the next 6 months. That is less than half the 9.6% rate last year, and about as low as giving someone a pedal-powered wheelchair. And what's worse, you're paying federal income taxes on that interest when you sell your IBond, so you're really getting a lot less. That's why I wanted to highlight the 5 better high-yield alternatives for your cash. And first up, for safety, it's hard to beat the safety of gold, but I've got a better way to produce a yield as well. With inflation hitting that 4-decade highs last year and still higher than it's been for years, gold hit an all-time high recently at $2,167 per ounce. You don't usually think of gold as a great return, but it's actually yielded 8% annually over the last 24 years, and it is the ultimate inflation hedge. Unfortunately, you don't get a yield or a dividend while you hold physical gold. Now, you could buy shares of the Spider Gold Shares ETF, the GLD, and then sell call options against it to create something like a dividend, but you're going to pay income tax rates on that cash, and I prefer the gold miners for a better upside return. Because those stocks are correlated to the price of gold, these are good inflation hedges, along with giving you the dividend cash flow. The VanEck Gold Miners ETF, ticker GDX, holds shares of 59 gold miners and pays a 1.9% dividend, but I like the individual miners based on their all-in sustaining cost. That AISC is the price the gold company needs to recoup its costs on production and capital investment, their break-even price for the miner. You can see in this table, with the gold topping $2,100 an ounce, Most of these companies are very strongly cash flow positive. One of my favorites, Agnico Eagle Mines, ticker AEM, has an AISC below the average at $1,125 an ounce and profit margins of 40%, so a very profitable company, and pays a 2.9% dividend yield. We'll get right back to that list, but you'll notice none of these have that guarantee of the US government. And it's getting harder and harder to say that with a straight face anyway, but none are guaranteed like IBonds. They do have some things you won't get with the IBonds though, like no lockup or penalties. You can cash out of these at any time rather than that 1-year lockup on your IBond money. And all 5 of these have a return potential at least twice that of the bonds. Another source of safe yield here, a topic I covered recently, dividend stocks selling for a discount. I'll leave a link to that video in the description, but the idea here is that besides very good dividend yields, all these stocks are already trading cheaply. They don't have much further to fall in any broad stock market weakness and have strong upside potential in a turnaround. One of my favorites in the group was Regions Financial, ticker RF, with its nearly 5% dividend yield. Higher interest rates have destroyed valuations and cash flows for commercial real estate, and because smaller regional banks hold 80% of the $3 trillion in commercial real estate loans, the fear is that massive loan defaults are going to kill these banks. The broader S&P Regional Banking ETF, the KRE, plunged 39% in last year's bank crisis and was recently fallen 13% when fears were reignited in January. But Regions has just 14% of its total loans in commercial real estate, about $14 billion of its $98 billion portfolio, which is much lower than the 60 or 70% we see in troubled banks. That means the recent sell-off could be an opportunity to pick up shares at a discount. Trading it for a price of just 1.14 times the bank's book value, you can see that the current price to book is well under that 1.5 times book value the shares traded at in 2022, before this crisis in regional banks. And anytime you can get a bank close to its book value, it's a good deal. Of the 17 analysts covering the stock, the high target of $27 a share is 46% above the current price. Even a move back to that 1.5 times book value before the crisis would be a 31% return from here. Again, I'll link to that video with the other 4 cheap dividend stocks, the one with 500% upside to the top analyst target, at the end of this video. I've also been investing in a safer alternative than stocks, but with a 7% cash yield through Worthy Bonds, a fixed income platform with bonds backed by small businesses and short-term real estate loans. When that yield on the IBonds started to drop, I went looking for these kinds of high-yield alternatives and started investing in Worthy. I started with a smaller amount to test it out, but you can see I've already earned over $10 interest in just 3 months on my 50 bonds. You can invest as little as $10 per bond and earn interest on a daily basis. Best of all, you can withdraw all or some of your money anytime with no fees or penalties. Worthy even has a roundup feature that lets you invest your spare change on purchases into bonds, automatically building your portfolio. I use this as a part of my bond portfolio, so I'll hold a portion of my assets in this, corporate bonds, and other fixed income. Then if, or I guess when the market drops again, then I'll have a ready cash that I can invest in stocks and take advantage of those lower prices. Beyond that, one of my favorite features though is this gifting option. You can get someone started investing and earning interest with just their email address and as little as $10. I'll leave a link below for more information. Use the link and you're going to get an exclusive deal I worked out for everyone in the Bowtie Nation. Buy 5 bonds and get 1 free. Invest just $50 and get $10 free. That is a 20% return on top of the 7% interest rate. So look for the link below or just scan the QR code here. Another source for safe returns is through low beta stocks. Beta is just a measure of volatility, how much a stock tends to go up or down compared to the market. For example, the SPDR S&P 500 ETF, the SPY, has a beta of 1.0 since it's the benchmark index, while Marathon Digital Holdings, ticker MARA, has a beta of 5.4, more than 5 times more volatile than the market as it jumps up and down with the price of Bitcoin. Looking for stocks with a beta of less than 1 then can be opportunities to invest in a part of the market that provides those stable, safer returns. And these safer stocks like Duke Energy, ticker DUK, with a beta of less than half the market, shouldn't surprise anyone. Duke serves over 8 million customers in 6 states across the Southeast and another 1.6 million customers for natural gas. It's in a regulated utilities market, meaning the government sets its rates and keeps out competition, all of which combine for a stable 10% annual return. Also on the list, Colgate-Palmolive, ticker CL, with an even lower beta of 0.41 and a 2.26 dividend yield. Of course, Colgate doesn't have that regulated monopoly like Duke, but it's about as close as you can get. The 217-year-old company holds a top market share in toothpaste, toothbrushes, veterinarian clinics, and hand soap, and the number 2 position in mouthwash, bar soap, and fabric conditioners. In fact, Colgate products are in more than 5 in 10 homes, more than any other household products company. The company is a dividend king, increasing its dividend for more than 61 consecutive years. So yeah, it's not going anywhere. And the safest stock in the stock market, Merck & Company, ticker MRK, with a beta of just 0.38, nearly a third the volatility on the market index. And you can see that in the 5-year price chart with the market index in green against these other 3 stocks. While Duke has lagged, it still produced a 4.3% dividend yield. And more important than the returns here, look at how much smoother these lines are compared to the market. While stocks have jumped up and down like a rabbit on meth, the ride has been much calmer in any of these stocks. So while there is always going to be more risk in a stock versus something like an IBond or treasuries, this is about as safe as you can get, and you're going to get a much higher return along with a nice dividend also. More controversial than the other alternatives, but also the highest return here, selling deep in the money calls on a stock. I know we're moving light years away from that idea of guaranteed return and safety, but hear me out on this because there is a way to do this that gives you maximum safety and an amazing return. I'm going to set this up with shares of Marathon Digital, ticker MARA, probably one of the most volatile stocks in the market, just to show you can get a safe yield on anything, but you can use this strategy on any stock. We see here shares are trading for about $19.41 each and have been as low as $7 over the past year. If we go to the options tab, we can see the dates available for options contracts, and I'm going to use the January call options. Remember, selling one of these against shares that we own means we sell to another investor the right to buy the shares for a set price, that strike price that you see in blue here. For that, we receive this premium, which we see here in this last price. We get paid that cash right now for selling that call option. As an example, if we bought shares of Marathon for $19.41 each and sold these call options with a $10 strike price against them, we would collect $11.85 a share right now. That effectively offsets our costs, so we're really only paying $7.56 a share. That is really close to that 1-year low and is a 61% below the current stock price. It's not a guaranteed investment, but Bitcoin would have to plunge for Mara to get back to that level. And look at the return potential here. That investor that bought the call option is going to buy those shares from us before January next year and pay us $10 each if the stock is above that point. So if we sell the shares for $10 and we paid $7.56 after receiving that call premium, we'll be getting a 32% return on our investment. Maybe you want more downside protection though, so let's do this again with the $7.50 strike call options, committing to sell our shares for $7.50 in exchange for this $13.41 per share we collect right now. That means our cost basis for the stock would be that $19.41 current price minus the $13.41 we collect selling those calls, or just $6 a share. If shares of Marathon stay above $7.50 each by January, and it is very highly likely they will, we'll sell them for that price and collect a 25% return, while we've gotten the shares for nearly a 70% discount to the current price. And you can do this with any stock, selling a call option with a strike price so far below the current price that you lock in that huge discount on the shares. You're most likely to get that solid return when the shares are called away from you, but even if the stock plunges, you got it at such a discount that you set yourself up for a great return later. Get a 7% yield on your cash, plus a free bond, an exclusive offer for the Bowtie Nation with worthy bonds, and the link in the description below. Or click on the video to the right for the 5 cheap dividend stocks worth an average 152% upside. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.